Good morning, one and all. Myself, Aisha Sheikh. Today, I would like to explain about the basic information regarding income tax. Before entering the topic, why I am choosing this topic is nowadays most of the families they are in upper middle class. Maximum they are facing to calculate the income tax and the meaning of the income tax they don't know. That's why I would like to explain the brief knowledge, brief information regarding our income tax history, meaning, objectives, and calculation methods like this. Now we will be entered our discussion. The first slide of the income tax is basics of income tax for beginners. Beginners means without having any knowledge, if you want to calculate and if you want to know your tax burden, this information will be useful to you. Are you just out of college and fresher of job and you don't have your income, even though you want to know the minimum wants to know minimum knowledge regarding your income tax calculation. This slide will be give you the right information. And if you want to job enter a job in tax profession, those people also watch this slide, then they will get a good information. I hope this will be useful for college students and freshers and job holders also. This one will be explained about what are the types of taxes and their meaning and their calculation method. Are you just out of college and looking for a job, or have you already landed the job and are going to file your income tax returns for the first time? If nitty gritty of income tax and investment of confuse you, clear tax is here to help. Our aim is clear tax. Clear tax means without having any doubts or troubles, you can be able to calculate your tax burden. And so, clear tax is to simplify income taxes for you and make your financial life easier. Basically, anybody with an income is liable to file income tax returns. Today we bring to you the basic income tax you will need to equip yourself with, and it should help you to take a confident regarding your first step in your job. Now next slide will be explained about the previous year regarding your income tax. In the income tax we have 2 years. First one is previous year and the second one is assessment year. Previous year nothing but it will be explained about the income earning year information. Previous year or the financial year or your tax year. Your tax year is the 12 months period that begins in 1st April and on 31st March of the next year. No matters when you start your job, your tax year closes on 31st March. It means that your financial year or your income tax year will be start from 31st March to 1st April. Most of the girls they think that year means just 1st January to 31st December. But when we enter in a calculation of taxes, we will be concentrate on financial year only. That's why each and every candidate must to understand the beginning and ending of the financial year. The 31st of March and 1st April is the duration period of calculation of income tax. No matter when you start your job, your tax years closes on 31st March and a new tax year starts on 1st April onwards. So it's important to plan your taxes for each financial year. Now, previously we already explained you in our income tax point of view, we have the two categories of years. First one is previous year. It is nothing but this year will be explained about your income arising particulars. It means that when you want to calculate your tax, before that you must to understand how much earnings you earned in your previous year. Then only you have a clarity regarding your calculation of income tax. It means that overall I would like to explain to you income arising year is called previous year and tax paying year is called assessment year. It is a term you will offer here in a relation to tax filing. After the calculation the tax, you must to know the deductions and assessment years and previous year and exemptions and terms and conditions and sections. All those things will be play an important role to calculate the final payment of your tax. Now we will be discussed about the assessment year. It is the second part of your tax. It's a term you will often hear in relation to tax filing. It is the financial year after the previous year. It means that this year we will be calculate the final payment of your tax, in which you will be assessed and file your return for the previous year. So assessment year is 2009. If for example your assessment year is 2019 and 20, then your previous year is called 2018 and 19. It means that you remember always your previous year is before of your assessment year. Now next assessment year is the year in which you have the assessment year is the year in which you will file your returns for the previous year. For instance, if you start your job on 1st January 2019, your tax year closes on 31st March 2019. It means that whenever you start your job or your career or your business, whatever it may be, you must to close down your accounts on 31st March 2019. So then it is a benchmark to calculate the tax 31st March to 1st April. Now we will be discussing about the 2018-19 is your previous year. Then what is your assessment year? Your assessment year will be a coming year, that is 2019 and 2010. And the last date to final your returns is 31st August 2019. Now we will be discussing about the next slide, understanding your salaries. It means that in our Indian economy, each and every middle class or business person and most of the candidates, they are earning their monthly basis. Monthly income is called the salary. When you start your job, reach out your payroll or house rent department and get your salary details, pay slips and tax statements. Here you will get an idea of the major components of your salary and how much tax will be deducted from your salary based on them. Now next slide will be explained about the income on which you pay tax. Beside the salary income you receive, you may be earning and income from several other sources, because the salary is the one way of the sources of income. And it means that overall we have the five categories of incomes: income from salary, income from business, income from house rental properties, income from capital gains, and income from other sources. Now in this slide we will be discussing only regarding your salary, your total income. If you want to calculate the tax, first of all you must to analyze your total income is the sum total of all heads of income below. Now sources of income. The nature of your income, we will be divided 5 categories of incomes. First one is income from salary. Salary or allowance, leaves enhancement, basically are the money you receive while rendering your job as a result of your employment agreement. Now second source of income is house property. Most of the guys, they are also having the income of your house property. House property income from house or building or flat is called income from house property. This may wandered and self-copied or may be rented. Income from capital gain. Income from capital gain or loss when you sell a capital asset, then you will be get profit either loss. So this type of margin is called capital gain. Now next income is income from business or profession. Income from your business or your particular creativity or profession. These types of incomes carry forward in income from business or profession. This criteria comes under the category of fourth income source. Now last source of income is income from other sources. This is the residual head. Includes your income from savings bank accounts and fixed deposits, rent, interest, and dividends. All these types of incomes and family pensions, gifts. These incomes comes under the category of income from other sources. Now we will be discussing regarding the deductions. In our income tax calculation, we have some deductions also. Those are main deductions. Here I will be explaining about main deductions. The deductions reduce your gross income. These are the amounts income tax department allows you to reduce your income, bringing down your tax liability. Some of all heads of income, gross income, some of the all heads of income is equal to gross income minus deductions is equal to taxable income. Next slide will be explained about the make section 80C. 80C is a main section. That's why I would like to explain which issues will be covered in our under section 80. You can take off INR 1 lakh up to 1,50,000 from your gross income under section 80C. Widely used and another benefits also we will be getting. Benefit means deductions under 80C. Those are first one is PPF. PPF, one of the most popular deductions under 80C is deposits to public provident fund or it is called PPF. When you open a PPF account, you need to deposit a minimum of rupees 500 and maximum of 1,50,000 in a year. Money deposited in PPF account compounds as you deposit more money in the subsequent financial year to claim deductions. PPF is a traditional and safe saving revenue to park your hard-earned money. A PPF public provident fund account can be easily opened with a bank. Now next we will be discussed about the tax saving in fixed deposits. It is called FDs. Fixed deposits assure capital protections as well as a sizable interest income for investors. To get tax benefits under ATC, you need to stay invested for at least 5 years. It is safe, but the interest income from it is taxable. Now next one, ELs, tax saving mutual funds, or ELSS. One of the mutual fund scheme allowed under ATC ELSS, equity linked savings schemes, is gaining popularity among people for its historical higher performance in the recent years. Another perk of ELSS is that it has the lowest lock-in period of 3 years. TDS or tax deducted at source. TDS is tax deducted at source. It means that the tax is deducted by the person making payment. The payer has to deduct an amount of tax based on the rules prescribed by the income tax department. For instance, an employer will estimate the total annual income of an employee and deduct the tax on his income if his taxable income exceeds INR rupees 2,50,000. Then tax is deducted based on which tax slab of. It means that if you want to calculate the tax, you must to follow the slab systems, because in our tax calculation systems we have the two calculation methods. Those are, first one is slab rate method, second one is flat rate method. Slab rate method, if you want to implement in your financial year calculation method, in that situation you must to divide your total income in different slabs. So for example, if you have the 10 lakhs of income in every year, you will be deducted your first amount 2,50,000 as a basic deduction. Next, remaining amounts will be comes under the categories of different slabs. The tax is deducted based on the incomes and deductions and under sections. Similarly, if you earn interest from a fixed deposit, the bank also deducts the tax deduction schemes. Since the bank does not know your tax slabs, they usually deduct tax deduction schemes at the rate of 10%, unless you have not mentioned your PAN. PAN means permanent account number. Every taxpayer must and should have the PAN card. Without having the PAN number, you can't able to submit your tax returns. In that case, if you are unable to provide your PAN card, in the situation you must to pay the 20% of tax deductions to your bankers. Now next one is calculating tax payables. Now it is the last stage of calculation of your tax payments. On your taxable income, tax slabs or rates are applied and final tax payable is calculated. It means that we already explained in our previous slides that based on the nature of your resources of income, so we will be divided 5 categories: salary income, income from house properties, and income from business, and income from capital gains, and last but not the least, income from other sources. You calculation of the total income of these 5 categories, the income is called total income. When you get a total income of an individual person or organization or anywhere, then afterwards you will be deduct your tax deductions, and afterwards you will be divide the remaining amounts in slab rate based system. Now the methods of calculating tax payable, we already explained you slab rate system and flat rate system. On your taxable income, tax slabs or rates are applied. Thank you, Vanilla.